Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for the next 30 minutes here on Options Guide TV. All right, so markets are still in choppiness land, and April 2nd is the big day, and a lot of headlines. Once again, a lot of uncertainty. The VIX is actually coming off a little bit, which is interesting to see that we've dropped below that 20 level. I actually wouldn't mind doing a VIX trade here shortly. If we get back down to the 17 level, I don't think the news headlines are over with. April 2nd is going to be a big day. They're leaning towards kicking some of the tariffs down the road once again. And, well, one day the headlines are that they're going to be increased tariffs, and then the next day they're not going to be as bad as first thought. And so the markets are choppy. Every day we start up a little bit, and then all of a sudden we seem to give it back and never really quite know where we're going to end up at. So I do like the trade that we did this week on Monday. It worked out well, actually, and you might have even been able to close it at a halfway decent net credit to the account this morning. So I'm going to do a rinse and repeat in the S&P 500 index. We're going to look at another skip strike butterfly. And once again, these to me, I should come up with a new name. I should come up with a alternative to a short call spread, because I think that is the best way to sell this strategy, if you will. So, but it's a skip strike butterfly. It's exactly what you're doing, but the goal here is to try to make the net credit. And if you're getting a decent net credit in the account relative to the amount of capital that you put up, especially if you can do it in a couple of days, it's a solid strategy overall. So with the markets the way they are, I'm going to go back to the wheel once again, and we're going to do another SPX trade. So let's run to the Tradier Pro software, and I'm going to start in the what if calculator. So if I look at the what if calculator here, this is the trade that we had on, and I'm going to slide this up a little bit. We went with the Wednesday expiration. So these options close at the end of the day today, and we went fairly far out of the money. We went about a 1 standard deviation move out of the money, and that's where we set up our skip strike butterfly. Market right now is at 57.58. And we landed, and we would like it to come out like right at this point in time. From this point on, it would be nice if the market actually came back and landed within this range between the 50, anywhere above 58.53. We obviously don't want it to blow through this marketplace, which is very low likelihood that it would happen. But even if it did, if it hit the short strike, you would just get out, and you would be able to put this on for a credit and take it off for a credit. So I'm going to add this to the trade ticket to start with, and we'll run over here and we'll look at this. And right now it's 5 cents to take it off if you wanted to close it. There's no real reason to pay a net debit. A couple of things to think about if we say that. Well, first of all, it's a cash settled index, so you don't have to worry about being assigned and getting 500 shares of the S&P 500 index, or 100, I guess, in this instance, because we did a 1 by 2 by 1. But so there's no reason to worry about that. If they do actually get exercised, or just cash goes in the account where there used to not be cash, and it would be that simple. So the market is down. Looks like they're going to expire worthless. Why pay that nickel and close it out? Because if it did come back, you could actually sell it and gain potentially $5 on this trade if it closed somewhere between 58.30 and 58.35. So a lot of benefits of trading in the cash settled index as opposed to the SPY, where you're actually trading stock. Here it's cash settled. All that happens is that cash changes hands. And then on top of it, if it expires worthless, great. We sold it for 40 cents. Did anybody get a fill at that 40-cent level? I'm going to actually put this trade on in my account. I didn't put this trade on Monday, but I'm going to do this trade right along with all of the listeners from Options Guide TV. going into the market. I don't have anything speculative on at this moment, so I'm going to end up doing this trade in my own account. So in this instance, we're 57.60 right here, 57.61. And we're going to go one standard deviation out of the money. We're going to go to the March 28th expiration, which is 2 days away. So you got half a day today, all day Thursday, all day Friday. So center it around the one standard deviation move. So 16 delta is right here. So 58.30 would be right about a one standard deviation move. If we buy this option contract and we sell two of these, oh, I got too many legs. 1 second. I buy this option contract, okay? And I'm going to sell two of these. We're going to skip this one, and we're going to buy this one. 55-cent net credit. Okay, so we got 40 cents before. Let's go 50, because we got 40 below before, and I'm pretty sure we could have got filled at that price. Curious if anybody out there in webinar land got a fill on that price on that trade. Okay, so we're risking $500. That's your margin requirement, which is the difference from 58.40 to 58.45. So that is our credit spread that we're selling. And in concept, if you look at this, that's trading for about 65 cents. We're doing this for a net credit of 50 cents, but we have a hedge automatically embedded. So we're giving up a little bit of our credit to have some protection. And hence, if you were thinking about selling this credit spread, 58.40 to 58.45, this is a viable alternative based off of that trade. Just in general, a very viable alternative to do the trade. So net credit of 50, maybe you could get 55. Market's right here. We're still at 16, 58. Yeah, not bad. So how many points do we have? I didn't grab my calculator and bring it over here. 40 and then 30. So we're talking 70 points for it to get up to 58.30. And it's okay if it does it on Friday. You really don't want it to get to that level on Thursday if you can help it. But if not, on Friday, that would be a good thing. And you'd be able to put this thing on for a net credit and probably take it off for a net credit. You obviously don't want to have a 2 standard deviation move, because that's where our risk kicks in. Above 58.45 is where our risk is at. So I'm going to send this to the what if calculator, and this is going to be the second paper trade this week in the S&P 500 index. But the more and more, as long as the VIX is hanging close to that 20 level, it appears that we can get these done for a decent net credit. So I like the trade as long as we're getting close to that. Well, 40 cents, I think, was even good, which we did on Monday. So I don't mind that at all. Let's go in and grab this corner. All right. So here is the what if calculator. Here is the trade that we're proposing over the next couple of days. The market is at 57.60 right here. We up towards this level. If we land between this strike and where we cross the x-axis, we're safe. This is where the short spread kicks in, and that is your risk. So from there on up, you have the risk of $500 minus the net credit received of 50 cents, of $4.50. That is your maximum risk. Anywhere below here, we're fine. We're okay if we land in here on Friday, but if it happens by the end of the day today, or it happens by the end of the day tomorrow, you will not be profitable on the trade, and then you need time decay to work for you. Bottom line is if the market does not go above the 58.35 strike, if it does not go above that, you're going to be okay in this trade. And my attitude with the trade is that, let's say we woke up tomorrow and we were up the 70 points, which would be a strong move on the open. If that happened and it hit the 58.35 strike and I was down on the position, I would just get out. So I want you to have realistic expectations, right? And I'm not really doing it as much so on the price. I mean, I guess you could say to yourself, if I'm down $1 on the trade, I could bring in 50 cents. If I lose double that, right, I'm going to get out. And that's a different way to look at it. But to me, it's all about where the market is relative to time decay, because you play a very sensitive time decay game with the strategy. The market being at 58.35 on Friday, at close to the close, woohoo! Getting there today, no, bad news. So the fact that you are selling two of these at the money option, or these 58.35 strikes, you need some time decay to happen on that option contract. And if it's an at the money SPX option, they trade for a lot, even with 1 day's worth of time premium. But I like that we can get this done. I kind of have a feeling like if the VIX was down around 15, 14, we'd have to either be tighter, right? They have to be closer to where the underlying stock is at, or have to receive less credit just in general on the trade. So I like the VIX around 18. I like that number, but I do think that there's potential for the VIX to go higher. So next week, I think we're probably going to look at a VIX trade. Maybe we do it on Friday, because Monday has a tendency. Yeah. So I think we're going to shoot for a VIX trade on Friday, now that I think about it. So if you have any questions, I do see a comment. I closed yesterday at 5 cents to avoid potential gap up, which burned me on a couple of the last SPX trades. That's fine, Fresh. No problem with that whatsoever. Closing it out for 5 cents is not a worry. And the fact that you did it yesterday, well, the market still could have moved against you. That's fine. If you did it today, it doesn't make sense. So to me, yesterday closing for 5 cents makes sense. Closing today for 5 cents does not. Fair enough. Why? Because if the market did come back and landed within the strikes, you could actually have a more profitable trade. I mean, in instances, the upside on this trade is $5. The downside is $5, but the upside is $5 too. If it landed right at the strike price, very hard to get that $5. It'd have to happen very close to expiration and hit that strike. But even if you could close it out for $1, a net credit of $1, put it on for 40-cent net credit and take it off for 40 cents. All right. And then Fresh, just to make it simple, what did you execute the trade for? What were you able to get it executed for? Was it close to the 40 cents? Because that's what I'm more curious about. Because if I could get this done for 50 cents today, I like that trade. Wondering what you executed the butterfly for to start with. All right. And any other questions and comments, feel free to put them in the chat box. If you're on YouTube, if you're inside the Tradier Hub, you can also ask questions as long as you set up a profile, which is 100% free. And then lastly, you can do it through x.com. If you open up the video and engage it instead of just watching it in the normal stream, you can also ask questions via x.com. All right, 35 cents. Sadness. We were trying to get 40, but yeah, it's kind of hoping we get 40. Thank you for that information. So I don't know if we could get 50, that would be a really good trade. But if we end up 45, I'm still not that upset about that on this trade. But 35 cents is still solid. It's still solid relative to what you would have received if you executed the short call spread. All right. So then I got one other trade for you today. And so starting to look at some other stocks, thinking about maybe getting some bullish attitude on cherry picking some stocks out there. The Next Era Energy, read a couple of things on it. Don't mind this underlying stock. Fundamentals are decent. And they have earnings coming up. So whenever we have earnings, that to me is always enticing. It's enticing to do advanced strategies the week of earnings. It's enticing to try to use earnings to your benefit on your trades. So that's part of the reason why I want to talk about NEE, Next Era Energy. And it's because I can buy an option contract that is 30 days out and expires after earnings. And that means that I'm buying some volatility right now, because after earnings, implied vol is going to be higher than before earnings, right? But we're 30 days out. So that skewing of volatility hasn't really begun yet. It's a little bit in that realm, in that if I look at the April 17th expiration, notice that Tradier Pro highlights the week of earnings, and it's going to be the 22nd right now. Well, at least that's, that's what the numbers are saying. It's anticipated to be the 22nd, but the vol is 25 here, and here it's 27. Now, 2 vol points matters. That is definitely a difference, but you would expect this to actually go a little bit higher. So if I'm buying an option contract and I'm paying a little bit more vol premium, it's because I anticipate that the vol premium will continue on up. Now I just got to get the direction right. So I take that component out. Now, I don't necessarily want to ride this into earnings. I really want to be out of the trade before that. But I would rather buy the April 25th expiration because of that than pay a little less and buy the April 17th expiration. So understanding what you want to happen to volatility and trying to make it your friend is a reason to actually look at things that are announcing earnings 30 days out. Sometimes we've done calendar spreads on this. We've done diagonals or calendars where you sell a shorter term option contract and you buy a longer term one against it. One of the issues here with that in Next Era is that there's just no premium. It trades historically at around a 26% implied volatility, and you got a $70 stock. So no real reason to sell anything shorter term. I guess if you were doing a lot of contracts, but on a one contract basis, you're just not bringing in a ton of premium because of the general price of NEE right now. So we're going to do the April 25th expiration. We're going to go a little bit in the money. Let's bring that, make sure we're in the right expiration. You guys watch me out there because I've done this before where I picked the wrong one. So the April 25th earnings is anticipated to be on the 22nd. So 22nd is a Tuesday, and this is obviously a Friday. And that's the one we would expect to get the most vol bump up in. All right, so I'm going to go a little bit by a little bit of delta. So let's look at the 67 strike, and we're going to buy a real option. We're going to end up with a 68 delta in this scenario. We're going to buy that contract. Let's switch it out then there. Yep, there we go. So $3.75 at the mid, $3.80 on the ask. When you're buying individual options, by the way, much harder to fill at the midpoint. If you do a spread, you give the market makers that are you're most likely trading with, you're going to give them a buy, you're going to give them a sell, and then that gives them a hedge and makes it easier for them to trade. So they're more apt to give you a midpoint fill. When you're buying an individual option outright, that's a little bit tougher to do. All right, so 375 was the mid. We're going to say 380. I'll mark it down as 380, and that will be the official paper trade in NEE. We're still riding, and by the way, on AMD, if you did do the roll up in strike on the call option that we talked about on Monday, because we've had a trade on an AMD for a couple of weeks now. Where's AMD? I just had it in there. All right, no big deal. Now it's all the way down there now. It's down 3% today. So you'd rather have it go up. That would be a good thing. But if you would have rolled and captured a profit on the trade and still be going, yeah, the stock came down. So it would have been a good time to roll on Monday. We don't usually get that lucky, but that would be the scenario. And then you'd still have the trade. Still want to stay bullish on AMD. It's just had a strong run up on the charts and probably given a little bit back. But I think we still got at least 30 some days left on the trade. I don't have it up in front of me, something like that. So the roll was good. And if you did it, that's great. And if not, well, you're still profitable on the trade. Not that big of a deal. All right, everyone. Any other questions that we have? And yep, that's going to be it for this edition of Options Guide TV. I'll mark down NEE, Next Era Energy, and we will look on Friday at the SPX trade, and I'm going to put that one on too in my own account. I like, especially if I could get it done for 50 cents. So I'll let you know what price I was able to fill at. Thanks for stopping in, and we will see you this Friday at 11 a.m. Eastern Time for the next edition of Options Guide TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.